Hello all and welcome back to the channel. All right, so we're hitting all-time highs right now in the Dow Jones, in the S&P 500, and now the NASDAQ Composite Index. Just yesterday, we finished at an all-time high, breaking the old record that was set back in November of 2021. So I'm guessing we're all doing really well in the market right now. And if you follow this channel, you know I'm doing particularly well because about 58% of all the gains in the S&P are coming from only four stocks. They're coming from NVIDIA, Meta Platforms, Microsoft, and Amazon. And of those four stocks, I've owned two of them the whole entire time this market has been ripping. So yeah, I'm doing really quite well. But interestingly enough, it's made me realize that owning all the right stocks, even as they're ripping, isn't enough to make me like life-changing money. You know, like I've been correct about everything in this market. I feel. I mean, I've nailed everything. It's like last June, right? I got out of the market in July, went into short duration fixed income until about the middle of October. Then started going back into equities, and then went full bore into equities in November. And so I've got it all right since June. And since then, I've only made about $55,000 in the market. And this is in the portfolio that I allow myself to kind of gamble with, you know, the one I talk about on this channel. And so, but in this gambly portfolio where I've gotten everything right, it's just I've only made $55,000. So I'm not about to go out and buy a Lamborghini. I'm not going to go get some outsized house. I am going to go ahead and buy a barbecue grill. Shh, don't tell Jerome Powell, but yeah, I'm going to spend a little bit of it. Don't get him all upset. But I do intend on buying that grill. But it hasn't been like life-changing money. You know, $55,000 isn't life-changing money for me. You know, like what is life-changing is, I know when I completed dental school, that was life-changing for me. And before I was a dentist, I was a computer programmer. So I went to, you know, college and I graduated. I went from being a waiter at Chevy's Mexican restaurant to being a software engineer. And that was life-changing for me. But $55,000, even getting everything correct, that just isn't life-changing for me, though I'm not complaining. It makes me really happy, but it did make me realize that this market is not for making like life-changing money in a really short amount of time, no matter what some channels might tell you. I mean, unless you do something really crazy where you could just lose everything, like buy some wild out of the money call options or invest everything in like some kind of crypto coin that's going to the moon, in which case you might as well just go to Vegas and bet it all in black, you know. So but it's the market is just not designed to do that. It doesn't seem, even if you get it all right, and even if you do it for like, I guess now 8 months in a row, I've been nothing but correct, and I still haven't made life-changing money in it. But what it does seem to be good at is, it does seem to be good if you buy a really great company that is growing revenue and earnings over a long period of time. It will generate nice returns over a certain amount of time. Or maybe if you dollar cost average into an S&P index fund, say for 30 or 40 years, you come back 30 or 40 years later, you might have life-changing money in that portfolio. And that seems to be what the market is designed to do, no matter how good you're calling it. But that's not what this channel is about. This channel is about trying to predict where the market is going in the short term and seeing how much gains we can get out of this thing in the short run. And that's exactly what we're going to do today, even if the money isn't life-changing. So in this video, what we're going to do is we're going to talk about what direction this market is going. It's definitely in a bull market right now, but is it going to continue, and if so, for how long? And then I'll go ahead and talk about a few of the purchases or portfolio changes I made over the last couple of weeks that you might be interested in, and why I made those changes. All right, now before we get into this, I'd like to thank Bob and Chuck for their continued support, and I'd also like to thank Taylor, We Win, and Erica for the new subscriptions. I definitely do appreciate the support, so let's go ahead and get into this. All right, so as it relates to stock market gains, I've already made everything that I plan on making this year and next year in the market. So I'm always kind of looking for an exit strategy, especially when, you know, short duration fixed income is like trading over like 5.4% or 5.3% or what have you. I'm always looking for a time I can pull my money out and just kind of ride it out in comfort in these treasuries. But the market's not quite letting me do that yet. As a matter of fact, I had a friend, Steve, he came up to me a couple days ago, said, I got everything on the market, it's going too good. I'm like, no, man, we're in a bull market. Get that money back in there. What should I buy? Amazon, just buy it. That's your stock. But anyway, on that note, let's go ahead and see why this market is just not allowing me to go into these short duration fixed income here, in at least not yet anyway. So here's an article here from CNBC. It says, something unusual is happening with the S&P 500, and it could mean more gains ahead. So as February wraps up Thursday, the broad index is on pace to finish more than 4% higher. That would mark its second straight winning month of 2024. It would also be the index's fourth winning month in a row going back to November. In calendar years with a positive January and February, the S&P 500 ended up by 19.9%, let's call it 20% on average. And this is data going back to 1950. In the final 10 months of the year, the benchmark saw the average increase of 12.2%. From here, it would be on average, we should go up 12.2% from now until the end of the year. Now, there have only been, believe it or not, 28 instances in which the S&P 500 has risen over the first 2 months of the year. In all but 2 of those times, the benchmark has been higher for the rest of the year. Looking a year later, it was up in 27 of those 28 instances. It might only be curious market statistic, but we found further reason for optimism considering the fact that this would mark a winning streak between November and February. In instances since 1950, when the months between November and February were all higher, the S&P always closed the new year in the green. And on average, the index jumped 21.2%. So it's 20% if only January, February are up, and it's 21.2 if it's November through February. And also every single instance that it's November through February, it's finished up, versus the other one is 27 of 28, which I still like those odds. Now, by comparison, if January and February are not up, the index added 8.1%, and it only averages up 73% of the time. I think we get the point. This article goes on and kind of drones on about this, but let's go ahead and look at this video between Scott Wapner, who's freaking 2 thumbs up, Wapner, Santoli, those guys are great, Steve Leisman over there on CNBC, and he's interviewing Sylvia Jablonski from JP Morgan. Let's see what she has to say about this.
Should we believe in a stat like this? Since 1930, the S&P has seen 16 cases in which the 4-month period from November through February were all positive, and the full year has been positive in all 16 cases. I mean, that speaks to momentum. It speaks to why perhaps we got here in the first place, and whether the trends that have been in place are going to remain in place enough that stocks can actually have a good remainder of the year.
Yeah, and I think it speaks to how low sentiment had gotten late October, right? It was that higher for longer. Is the 10-year going to 6, 7? What's going to happen with pockets of the economy? What's going to break next? Into now fully more appreciating that we can handle high rates and that you can have a soft landing or positive growth. So we do think there's a bit of a sweet spot here where growth is resilient, so good enough, at the same time that inflation's normalizing, but it's still there. So nominal growth is supportive of revenues, and especially as margins are stabilizing. What I worry about, though, Scott, for the rest of the year is eventually that narrative goes too far, right? We're still talking about being later in the cycle, which means really a focus on quality is still important, and it's too early to go after the kind of companies that are low quality or the kind of sectors that need rates to come down, which is actually what's up today. It's a bit early for that.
So she does bring up some really good points. You know, earnings have been very strong this quarter. And overall, this strong economic data, through like GDP and through persistent inflation, it has signaled to the market that the Fed's not prepared to cut rates anytime soon. And despite that, the market is still going higher. It's like it's absorbed this data and it said it's all right with it. And that's because with these earnings coming in strong and with GDP coming in strong, it's like looking like good news is good news for the stock market. And the stock market going up, it's very positive as opposed to maybe in 2021 when this happened, because this is being driven by our very best companies having very strong earnings. And if you look over a lot of the earnings reports that have been coming through, we've had mostly revenues have been in line, earnings have been up, and there's been like a lot of stock buybacks. And with the earnings being up, that tells the market and signals, at least to me, that that operating margins had troughed last year and now they're starting to widen. I don't know how they're doing it. They might be cutting staff, they might be cutting costs in some other way. But in either case, it does seem that operating margins had troughed last year and now they're getting better. And so these largest companies seem to be pulling out of this. However, with the Fed not cutting interest rates anytime soon, it is not a good thing for smaller companies that need these short-term loans in order to keep their operations going. So right now is not exactly the time to get into these Russell 2000 stocks, even though they're trading at very low valuations. You're going to hear over and over again that small and mid-cap stocks are trading at very good valuations, but there's a reason for that. It has to do with high interest rates. There will be the day when these stocks will be bought up. It will come when we start to bring interest rates down, but that day is not today. So let's go ahead and look and see if we go up with the S&P at 12.2%, where that puts us at the end of the year. All right, I don't usually record while the market is open. I just happen to be off today. It looks like the S&P is currently sitting at 5109. Let's call it 5100. If we add 12% to this, then we would say that the market should be trading at the end of the year at 5,700. Now, that's probably a little bit on the high side. The law of large numbers tells me that that probably won't come true. But I mean, if history says like it has anything to do with it, the S&P at the end of the year will be 5,700. But let's say the law of large numbers, maybe it's 5,500, 5,600. But in either case, this is not a time for me to be exiting the market and going out into short duration fixed income. Now, another reason why I want to stay in this market is because on March 12th, we're going to have our CPI data be released. And it's my expectation that this CPI data is going to show up in about the 2.9%. I'm going to be pretty much in here with what's going to be the consensus. Now, the consensus might show up about 2.8 or 2.7. If you want to see why I believe this is actually going to be showing up a lot lower than 2.9%, check out my last video. I go into detail about that and I crunch the numbers for you if you're interested. But having this 2 in front of this inflation print, I think is going to send the market higher on March 12th. And also another thing that's going to be happening very soon after that is we're going to get this NVIDIA convention, and Lord Jensen is going to speak here on March 18th. They're going to have an AI conference and expo, and it's going to be hosted by Jensen Huang and NVIDIA. This is certain to bring the market up, at least in my opinion. I'm looking for all these AI stocks to go up during this week of March 18th through 21st. And Jensen's only expected to speak for about 15 minutes, but 15 minutes is all that man needs to make the market go higher. And who knows what he's going to unveil. But I would expect that the market's going to be higher. And in that case, I will not have any covered calls at all going into this week, because I don't know what's going to happen, but I think it's all going to be good news. Another reason why I can't quite leave this market is because statistically, the best month of the market is July, but the second best month of the market is April. And yet that's another reason why I can't leave this market just yet. I still think that we're headed higher. Another reason why I think that we're headed higher is we got our PCE report that came in on yesterday here at February 29th. Now, this is the definition of a soft landing right here. So the inflation has come down. The PCE, the core is 2.8%. It's not as good as it was a couple years ago, but it's a steady decline. But what I did notice right here that I really liked is that personal income rose 1%, which was well above the forecast of 0.3%, but spending decreased 0.1% versus the estimate for a 0.2% gain. So what's happening is that we're having wages are keeping up with inflation, right? And we're having wage growth, but we're not spending this money. Money is decreasing. Like, people are kind of scared to spend it a little bit, and they're kind of socking some away. So we've got the ability to buy more. Savings are going up, but we're not spending as much. So this, to me, is an indicator that that inflation will be coming down. But wages are going up, and people are going to feel pretty good about the economic situation. And to me, this is when they say soft landing, this is what it means. And also, the job numbers are still really strong. And so this is the definition of a soft landing. And this is yet another reason why I can't exit this market. Now, another thing that I see coming in this market is, this came out this morning, that Europe is having its worst earnings season since the onset of COVID, with a little hope of a quick turnaround. So what does this mean? So this means that I believe that Europe and the UK, they're going to cut interest rates before the United States does. And what that means to me, that signals that we're going to have a stronger dollar, at least in the short run, relative to the euro and to the UK sterling pound. And so if you're the kind of person that likes to trade Forex or whatever, this might be the time, because the dollar, I suspect, is going to get stronger relative to our European counterparts. Now, another thing that's happening that's with this market is we're having a broadening of this market, where it's not just these four stocks. We're seeing it going to other places. And in fact, a lot of the overbought stocks aren't even in tech anymore. They're industrials, they're financials, they're ETFs like the XLI. But if we look here under the technical analysis, and we only want to search for stocks that are trading with an overbought RSI, let's say over 70. So an RSI is a technical term, and 50 would be pretty much in the middle. Anything under 50 would be considered oversold. Anything over 50 would be overbought. Something overbought generally indicates that the people are piling into that, and the stock price is going up. Anything oversold indicates that the stock price is coming down. So if we look at overbought stocks right now, we're going to find that a lot of these stocks, and let's arrange this by market cap so that it's companies that we've heard of. You can see that a lot of, like, Nvidia is very overbought. It's over 70. Meta's up there. Eli Lilly's up there. Broadcom, JP Morgan. But you're going to see that a lot of these overbought stocks right now, they're not tech. They're healthcare, they're financials, they're consumer cyclicals. Home Depot's overbought. I guess we're predicting a big, interest rates coming down and the housing market might go up. We're expecting that interest rates will come down and the financials will go up. But my point is that this market is broadening, and a lot of these overbought stocks are not your high-flying tech stocks as people would lead you to believe. So this is also bullish for the market. We're kind of going into everything. It hasn't quite hit the small caps yet, but that day will come, but I just don't think that this is the environment, the signal that those stocks are going to rise. And then another reason why I'm bullish on this market is we're about to get into another earnings season that starts on April 12th. JP Morgan, Bank of America, Citigroup, they always signal the beginning of yet another earnings season. That's coming in April. I'm not going to get out before then. So I'm definitely in through this time and probably through, the beginning of May, probably a couple weeks later, and then we'll reevaluate things. Now, I said I was going to talk about a couple of stocks that I went ahead and bought. It was very scientific. You may want to sharpen your number two pencils and get it out and figure out how I decided to buy these stocks. Believe me, it was science. So what all I did was I went over to the S&P 500. I had some money come my way because I had some short duration fixed income mature. And then now I have this money, got to figure out what I'm going to buy with it. And I'm not going to put it back in fixed income because I am indeed very bullish at the moment. So I decided what I would buy. So I went down this list of S&P 500 stocks and I said, oh, got one like it, own it, own it, own it, don't own it, got one like it, and looking for more alpha than Berkshire Hathaway, don't really want to own Tesla. Funny thing is that Tesla's kind of doomed for me because there's three kind of people that own a Tesla. There's one that's your first movers, your people that got to have the new gadget. Then you've got the person who's the environmentalist, and then you got a person like me who's just trying to save money on gasoline. And if gasoline is coming down and interest rates are high, you're not going to sell a ton of these. But when we see the gas prices go up, you might see some of these look like a more enticing sort of thing to purchase among a lot of people. But right now the environment's not right for a Tesla. Own Novo Nordisk, already got financials. United Health, they're closely tied to the company that I ended up buying, actually, but I didn't buy that. And so then I went down this list of things. I considered Adobe, but I looked into them a little bit and I didn't like their story going forward. And then I had to go to page 2, and it was on page 2 that I decided on the company that I would end up buying with my money. And that company came all the way down here at number 99, and that company was Palo Alto Networks. And the reason why I got into this one is because this thing had like this huge plunge. If you can see here, over the course of, say, the last month, it went down right here. It went from 366 all the way down to $104 down. And so it came down to about $266. And so right now it's having a rough day. It looks like it's down in one day here. It looks like it's down about $10. This is because Zscaler put out earnings yesterday and it, I guess, didn't have much of a guide. But in any case, this is the one I went with. I bought it for about $278. So I'm still up pretty good and I've sold calls on it. So this is the one that I decided to go with, even though I'm not that crazy about a lot of these cybersecurity stocks. And if you watch this channel, you'll know why. It's because I just think there's too many of them. Everybody's got a cybersecurity system going on. But these guys, in their effort to try and differentiate themselves, even though they reported good earnings and revenue, their stock plunged because they're having to give out like deals to get people to come over to them and utilize their service. And because of these deals that they're giving, their guidance was not as good as the street was expecting. And plus they're saying, why do you need to give such good deals? Well, that's because with Juniper and Fortinet and Palo Alto and Zscaler and CrowdStrike and everybody out there that's offering this service, and then of course Google and Microsoft have their own, with apparently there's something called Checkpoint as well. Everybody's got a cloud security thing. These guys just don't have any moat at all. So they're trying to create new business, and they believe their business is the best. Now, the thing that caused their stock to actually go up, and strangely enough, after I bought it, because I just seem to have the Midas touch these days, is it went up because United Health had a big cyber security breach, and it was the CEO of Palo Alto Networks that negotiated a contract with United Health to try and bring them aboard as a customer, and there'd be a big customer. So that caused the Palo Alto network stock to go up. Plus, I like them because they're one of the only cybersecurity stocks that actually report a profit. And talking about like companies that that you didn't even know were in cybersecurity anymore. I watched this movie here recently called BlackBerry. And it used to be that these guys made phones, and this was their whole business, but they're not making phones anymore. Even they're in the cybersecurity business. They do other things, automotive, consumer products. I guess they do still make phones. They make radar, But by and large, they're a cybersecurity business now too. It seems that everybody's in cybersecurity. It's very crowded. If Palo Alto starts to, go down too much, I'll let it go. But the thing I like about Palo Alto is the fact that they do have a PE ratio. They do earn money. Many of the others do not. Fortinet earns money, I believe. It's got a really rotten price to earnings ratio, I believe, but never mind. They don't earn money either. So I don't know. I like Palo Alto because they're the industry leader. They came down a lot. I thought it was a little unfair, but I do recognize that this is a crowded trade. Another one that I bought I bought Apple. And the reason why I bought Apple is because Apple is like one of these companies. They're very kind of like predatory to me, and I saw them. They were they got rid of they're no longer going to make these EVs, and so now instead of making EVs, they've decided they're going to go ahead and concentrate on AI. And I see Apple as the type of company that's going to say, all right, we've developed AI for our platform, and you have to use it through Safari on our phone, and we'll only make it available on the iPhone 16 or 17 or whatever they're coming out with. But they're going to make it proprietary to that phone right there, and they aren't going to release it on any earlier versions. If you want it, you're going to have to get the new phone. And I would be upset if I didn't own the stock when that happened. And so that's why I bought Apple. Plus, I noticed that it actually kind of troughed on earnings. It seemed not on earnings, but on share price. It got down to about $180. All right, so let's go ahead and have a quick look at my options portfolio here, and then maybe I'll even trade something in real time here, depending on what's going on. So these are the trades that I have open right now. I've got Goldman Sachs. I've got a lot of them that expire next Friday, because what I expected was that PCE was going to come in kind of light, and that things were going to go up, and they did, and then I would sell some covered calls on a good day. And so that's what I did. And so so I've got let's see, Palo Alto Networks with a $330 strike that expires next Friday. It looks like I'm up $294 on something that I sold for basically, let's call it $400. Maybe I'll just close that one out and see what to do. It's having a rotten day. Zscaler, like I said, it reported yesterday, and the street didn't really like its guide or whatever. It blew away numbers, but for whatever reason, it's down. I think just because it doesn't profit, and it just trades on a price to sales ratio, and the market doesn't really like that at the moment. Amazon is down right now because the covered call is down right now because the stock is up. Novo Nordisk, I waited until today to actually trade sell call options on this stock, because they had a television show that came on last night on CNBC, and I thought that it featured Ozempic, so I thought that was going to send this stock up, and it did. So then I sold a couple of covered calls that expire, it looks like on the 15th, at $170 a piece. And of course, NVIDIA is way up today. They got some analyst upgrades, but this is one, like I said, I really want ahead of that March 18th. I sure don't want to buy this back if I have to, but I might have to, because I'm definitely going to own NVIDIA prior to that conference. Let's go ahead and look at this Palo Alto network and see if there's anything that I'm going to do with this stock right now. And I'll show you guys the options that, like, kind of the way that my head kind of goes when I'm looking at, am I going to roll calls? Am I going to exit a position, or what have you? So Palo Alto Networks is sitting right here. It's starting to rebound a little bit. So if I want to do this, I better do it fast. And you'll remember I sold it for $400 yesterday, and then I can buy it back for a certain amount today, and maybe resell it at a lower strike and try and get a little bit more money out of this. Or possibly, remember, I bought it at $278 a share. Just go ahead and sell it and just make like a couple $1,000s. So our options are out there. What do we want to do? So let me go ahead and on this one, go ahead and try and close out my call position and see what this would cost. In this case, it would cost me $109, meaning that I would make roughly about $291 if I was to close this out right now. That's an option. If I wanted to close it out for 109, I could then resell it, right? Sell to open, let's say with this expiration of the 8th again, but instead of $330, let's say we do it for 310 because we think that this is really going, this Zscaler thing is going to really affect this stock right now. So I could capture another 1,000 on equity increase, and I could get another $378 right this second if I think it's going to stay below 310 by next Friday. Now, this thing is crazy volatile, so I'm not going to do that. But another option, if I thought that it was going to continue crashing, maybe I sell it in the money being where it's less than it is today. If I think this is going to keep on going down, I'll say, okay, I think this is going to continue to crash. Now, I know that this is a good company, and I know it's the only one that's profiting. I know it's the leading cybersecurity company in the world, so I'm not willing to do this right now, but I'm just saying if it was more questionable than it was. Let's say this was Zscaler. I would go ahead and then take this $1,400 and wait for this to collapse, and then hopefully get to keep your money and my stock. And that would be the way I would do this. Now, as it looks right now, because it's stopped this decline, I'm going to go ahead and leave it as is. I like this $330 strike. I think I want to at least get at least another 50 or 60 bucks out of this thing before I sell another strike on it. All right, let's go ahead and have a look at, I'll show you my watch list, what I do when just the companies that I keep an eye on. I like Zscaler because Zscaler, I like to watch them because they're, for me, they're the canary in the coal mine. When this thing collapses, the party's over. That's my signal, and that's why I watch it. Deere is a company I hope to buy someday. Goldman Sachs I own. DWAC I have a put that I bought on this. It says that the put contract is actually it's down today, though the stock is down pretty good right now. I don't know that this keeps up particularly well, but in any case, I'll ride this out. I bought it for 698 bucks. If I lose money, I lose money, whatever. So other companies that I like to keep an eye on, I like to keep an eye on Google, like basically your Mag 7. Apple, which I now own, I keeping an eye on. I'm having a bad day on this. Nvidia is about to break the $820 threshold I put on it. I'm going to hang tight though, because everybody upgraded that today. This one, I believe, is one of the more undervalued stocks in the entire market. I think that it's actually going to about $290. And so this is my biggest play. I love Amazon. And anytime I spend anything that's not on Amazon, I don't know why I do it. I just do. Another one that I watch here is Coupang. I just sold out a Coupang, believe it or not, to buy Google because I thought, Google was going to do better. And then I sold Google to buy Apple. And so basically I should have stuck with Coupang, but I didn't, I'm not infallible, whatever. I lose money too. And then of course there's Palo Alto Network. And then on this here, I keep an eye on Novo Nordisk here because I own that stock. It looks like I'm up. I have 200 of these, so I'm up pretty good on this one today, maybe about 900 bucks. But all right, well, that is going to do it for this week. I hope you guys enjoyed the show. Thanks again for supporting the channel. If you got any of this, please like, subscribe, hit that little notification bell. Until next week, we'll see you and have a great weekend. Bye.